Anomaly mode.
Hi, and welcome to the second DFSA RegTech Live event, Driving Innovation Through Compliance. This is a joint event between ourselves and the DFSA Authority. Now, before I go any further, can I just make sure that everybody has their microphone on mute, because sometimes there is a bit of feedback for the event. Right. So, my name is Elizabeth Wallace. I'm a Senior Manager in our Strategy and Policy and Risk team at the DFSA. I will be your MC for today's event. Today's event will be a mix of panel discussions, demonstrations, and keynote speeches. I'll just take you through today's agenda. We're going to hear opening remarks from Brian Starwalt, the Chief Executive of the DFSA. We'll then hear from our keynote speaker, Colin Lobo from HSBC, on the future of compliance. We will have our first panel discussion of the day, who are going to look at driving efficient risk management for automation, followed by demonstrations from two RegTech providers. The second panel of the day will focus on COVID-19 and the impact of regulatory compliance. Lastly, we'll finish up with a few closing remarks from Justin Balacano from DFSA. There will be opportunities to ask questions during the portions of the event. If you've got a question, can you please type it in the question mark on the interface? If you're on a laptop or a desktop, this will be on the right side of your screen. If you're on a mobile device, this will be on the tray at the bottom of your screen. There are approximately 300 people that are registered for today's session, so we might not be able to get to everybody's question. One last thing, if you're having technical problems, can you please check your Wi-Fi, your firewall, perhaps log out and log back in again. Sometimes there are glitches, but we've tested the function of this, the GoToWebinar, many times, and it's optimal. But I won't hold the event up any further. I'll hand over to Brian Starwalt, Chief Executive of the DFSA. Brian, over to you.
There we are. I hope everyone can hear me well. Good afternoon, everyone, and welcome to the second edition of our RegTech Live Driving Compliance Through Innovation. Let me start by saying thank you and for making the time to join us for this.
Hi, everybody. I'm really sorry. I think we've obviously had our first technical glitch of the day, and Brian's just struggling with his microphone. So we're just going to get somebody to come and help him and see what we can do. So if we just hold fire for that one.
I think I'm back on.
Oh, I think you're back on, Brian. Brilliant. Thanks a lot for that.
All right. I'll start again. Good afternoon, everyone, and welcome to the second edition of RegTech Live, Driving Compliance Through Innovation. Let me start by saying thank you and making the time to join the event, and a very special thank you to the speakers, the panelists, the demonstrators, and the moderators who are with us through this two-day exercise. As stated, this is our second virtual RegTech Live event, and until we can hold these in-person events, virtual events such as this one are an important tool for us all to stay connected. We're certainly working and living in extraordinary times. The COVID-19 pandemic has been a significant shock that has affected so many aspects of our lives. But we are very fortunate to be living in a country that has taken the health, safety, and well-being of its citizens, residents, and visitors so seriously and so thoughtfully throughout this episode. I am proud to say that the DIFC has been financially and operationally resilient this year, and we are looking at the future of the center positively. The future will certainly involve technology and specifically RegTech, which is our topic of discussion this week. I would assume that most of you, like me, were glued to the news stories about a potential vaccine that was announced yesterday. We will soon be watching the logistics of vaccine distribution, which will no doubt involve significant technology in tracking the recipients. We'll also need to consider that multiple vaccines might be effective, not just one, further complicating the logistical challenges, but further enforcing the need for technology. And technology is important to every industry these days. In recent years, many financial institutions have been using technology to support new business models or to solve regulatory and compliance requirements. The driver of this change was increasing operational and market efficiencies or enhancing the customer's digital experience, all to remain competitive in the marketplace. Technological innovations can take many forms, whether by digital transformations or the use of disruptive technology. The pace of change can also differ greatly, but this year has seen an acceleration of digital implementation at a speed none of us expected only 12 months ago. Many have found the digital journey difficult. The use of technology, specifically new and increasingly borderless technology, requires shedding of old habits, updating of cultural norms, upskilling employees, and adjusting many ways of thinking. Connecting the dots between digital initiatives, strategy, and business enablement is challenging, and adaptation is not one that all institutions or regulators have made seamlessly. However, only those who can adapt will be able to survive. It is also becoming evident that data and the harnessing of it is, according to the World Economic Forum, the new currency of the digital age. The value of data has never been greater, and financial institutions are looking for ways to create value using ever more increasing granularity of data. Of course, we also have to think about data privacy and data security in new ways. No doubt we're going to be hearing more about the value of and the potential limitations to data usage today and tomorrow. In the UAE, the tone has clearly been set from the top, and many of the discussions we will be having today and tomorrow would not be possible without the support of the UAE government and their desire to foster innovation in the country. In 2014, His Highness Sheikh Mohammed bin Rashid Al Maktoum, the UAE Vice President and Prime Minister and ruler of Dubai, set out the UAE Innovation Strategy. This has been critical in driving and supporting digital transformations in the UAE and has gone a long way to enabling new market entrants and existing businesses in their desire for digital transformation. Many initiatives launched at both a federal and emirate level support this strategy, including the Emirates blockchain strategy of 2021, which aims to have 50% of government transactions conducted on the blockchain within 3 years, saving almost $4 billion in transaction processing costs. Also, Smart Dubai, who will be speaking tomorrow on their role in supporting digital transformations, also help with access to emerging technologies and initiatives such as blockchain and artificial intelligence. The DIFC has embraced these strategies fully. In 2017, the DIFC FinTech High was established by the DIFC Authority to create and support innovative ecosystems in the DIFC. You will hear more from the DIFC Authority tomorrow on their future of finance strategy and their work in this area. The DFSA, the financial services regulator of the DIFC, is in complete lockstep with the DIFC Authority in driving a growth strategy for the DIFC consistent with our remit of being a financial services regulator. The DFSA launched its innovation program in 2017. And while the key initiative is the Innovation Testing License, or ITL, a licensed regulatory sandbox, the program also facilitates open engagement with innovative firms to understand new technologies which support financial institutions and their activity. The DFSA was also one of the first regulators to establish a team dedicated to operational and technology risks, including cyber risks. We have successfully launched one of the first ever regulator-led cyber threat intelligence platforms this year as well. And we're now looking forward to new ways of cooperation with the DIFC authority on data and technology as part of our future strategy of growth. Now, I mentioned above our regulatory remit. Although technology helps mitigate risk in financial services, it also brings challenges. The pace of change we are talking about, together with the borderless nature of technology, requires a level of caution to be taken as a regulator. We need to consider a number of difficult policy choices, including how do we balance the desire for innovation with the need to protect consumers and also allow good innovation that ensures associated risks are well managed. We encourage the use of technology in the delivery of financial services, as well as the maintenance of regulatory compliance. But we are also mindful of certain risks, for example, IT risk management and IT security arrangements, data protection, as I mentioned before, cybersecurity, and operational risk and operational resilience. Financial services institutions also need to make informed choices about how they are going to adapt to making sure that risks are understood, considered, and measured as they make changes to their processes and business models. Managing all of these objectives takes some balancing, and it is through industry engagements like this event that help to further develop our regulatory understanding of available and emerging technologies. I mentioned the borderless nature of technology earlier. This equally applies to the provision of financial services. On this basis, we talk to other regulators more than we have in the past, and being part of international networks helps us to share experiences and discuss what innovative approaches are being taken. The DFSA is a founding member of the Global Financial Innovative Network, GFIN, and while GFIN has a primary objective to provide a more efficient way for innovative firms to interact with regulators, helping them navigate between jurisdictions as they look to scale new ideas, it also provides a platform for regulators to informally engage on the uses of technology in the financial services sector and share experiences with each of us. The second RegTech event is again focusing on the use of technology in the financial sector, but this time we are focusing on risk management and risk mitigation and how technology can help financial institutions manage their exposures. The purpose of this event, much like the last event, is to generate awareness of available technologies and to demonstrate the DFSA's and the DIFC's support for the development and implementation of regulatory technologies. Our intention is not to promote any single vendor, technology, or approach. Rather, our intention is to make you aware of what is available and promote the consideration of technologies that you'll hear about during this event. Now, I'd like to introduce you to our keynote speaker. We're very pleased to welcome Mr. Colin Lobo, the Chief Compliance Officer for the MENAT region for HSBC Middle East. Colin joined HSBC Middle East in August of 2014 as the Regional Head of Financial Crime Compliance. And in May 2020, his remit expanded to encompass the role of Regional Chief Compliance Officer for MENAT. Colin has been a practitioner in the field of financial crime risk management for over 25 years, having trained and practiced with a Big Four accounting firm where he specialized in forensic accounting and regulatory advisory services. Colin is a fellow of the Association of Chartered Certified Accountants. We're lucky to have Colin setting the stage for us here today, where he'll discuss the future of compliance and how technology is being leveraged to achieve strong governance, risks, and control frameworks. So Colin, I'll turn it over to you and welcome to the event.
Thank you very much, Brian, for that introduction. Good afternoon, everybody. I'm privileged and extremely grateful to the DFSA for the opportunity to deliver the keynote today and to share with you some of my thoughts on the future of compliance in our industry and what it is likely to be expected of us as compliance professionals to continue to maintain a strong governance framework and enhance our risk and control frameworks alongside by embracing and leveraging on technology. I think Brian has kind of covered a lot of it in his introduction, but for me, looking back over the years, compliance has continued to change, but not at a pace, like it has in the recent past. No doubt the COVID-19 pandemic and its fallout has required a rapid response to challenges that we have faced. The exponential growth in digital channels, the economic relief programs by central banks, the new ways of working, and so on have required us as compliance professionals to adapt, evolve, and act quickly to support our business colleagues and to meet our regulatory obligations. Certainly at HSBC, we see our role in compliance as one of being able to help transform, to lead, and protect our customers. In addition, certainly our role as business partners who are independent guardians working together, applying prudent judgment to meet the expectations of our customers, regulators, and other stakeholders is important today, but will become increasingly important as the digital world evolves. And with that will come not only more regulations, but also increased expectations from those customers, clients, and communities that we serve. So even before the pandemic, from my perspective, set us on the road to a challenging economic environment, many banks were struggling to balance the polarizing pressures of a changing world and keeping to business as usual. There's certainly newer and newer technology bringing with it different challenges and evolving financial crime and fraud typologies, for example, which continue to plague all global firms and local firms indeed. We face a fight simply to keep pace with the increasingly sophisticated approach that criminals are adopting. Then there's certainly the regulatory conduct aspect, which is trickier to walk than ever. We as banks are making decisions today that will likely attract a lot of scrutiny in the near future from a conduct perspective. We must ensure that we have the rationale and data trail to back up what we are doing today and why we're doing it. And as if that wasn't enough, COVID-19 has meant that banks have had to accelerate what had generally been a gradual move towards remote working. The main concerns with this change is ensuring safe access to data and scaling for remote working for today and tomorrow with a potential increased insider risk. So with so much to tackle, it is hard for banks to prioritize when it comes to their compliance challenges. It certainly is for me as the regional CCO. And the three key trends that I think we need to confront and ready ourselves for a future characterized by uncertainty and continually changing circumstances are, in my view, the evolving regulatory landscape, secondly, the challenging economic situation that we are faced with, and lastly, the evolving risk landscape that those two bring to us. So if I deal with the first one, the evolving regulatory changes and that landscape. So over the past decades, banks have had to comply with an increasing number of regulations to guard against organized financial crime. Based on some of the research that I've done, Thomson Reuters reported that in 2019 alone, over 220 international regulatory changes occurred every day. If you multiply that, it's about 80,000 updates in that 1 year alone. I think we can all say that as a result of the pandemic and certainly the increases in the changes in regulations and laws, etc., we have seen that double in the first 11 months of this year. So looking ahead, there is certainly no let up in terms of regulatory pressure. As security is tightened and due diligence is improved, regulations will continue to appear and evolve to respond to the new risks that we will face, and we have to deal with it. Secondly, looking at it from the economic perspective, there's no secret, cost efficiency matters more than ever given the current economic environment. Organizations across the financial services sector are under increased pressure to become leaner and more efficient. Paradoxically, the increase in regulatory requirements often means more staff and higher operational cost. This is where technology-based compliance solutions will feature, and in particular, cloud-based solutions, which offer scalable and affordable bank services to banks of all sizes, allowing banks to free up time and resources to improve operations and allow for a more risk-based focus and quicker response time when managing compliance risk. In terms of an evolving landscape, as clients and customers, and as Brian also mentioned, move to online channels, banks are also evolving and adapting to the expectations and demands of clients. With the new ways of serving and engaging with our clients and customers, the risk profile is changing, and therefore our control environment needs to change and be fit for purpose from both a financial crime and regulatory conduct perspective. For example, as fraud is moving from a transaction-based attack to more identity-based attacks, fraud is certainly becoming increasingly intelligent and intricate. And therefore, banks must not only be diligent when making customers aware of the types of scams that they may be faced with, but also to have the controls to detect and deter fraudsters, to protect the customer and safeguard the integrity of the financial system. So as well as focusing on the external threats, banks also need to maintain due diligence and be alert to internal threats. They must be thorough when hiring new staff, conducting background and credit checks, vetting in other words. They must educate employees on how to work safely and securely, particularly as all of us or most of us are working from home, so that we don't actually expose the organization and indeed our customers to unnecessary risk. So with that as the backdrop, certainly regulators, and I'm sure the DFSA as well, are expecting us to innovate and not remain static to respond to the risks and challenges. And therefore, technology is and will continue to play a significant part in a compliance function of the future. And indeed, the skills required of a compliant professional of the future will change. So some of the areas that we at HSBC are looking to introduce or enhance our technology and digital capabilities within compliance are around automating of administrative tasks, driving more of a self-service agenda, looking at it from a better measurement and conformance and performance aspect, so looking at better MI, giving us more insight into the data that we hold to identify any horizon risks or any current risks that we're facing that we're unaware of, and then increase productivity and transparency. I think those are the, is the backdrop to where, and the backbone of where we are looking at it from a digital perspective and how technology can help us from a compliance perspective. So by way of example, I'd like to share a couple of things that we are doing in the compliance technology space at HSBC. Pardon me. Over the recent years, we have substantially improved our IT infrastructure to spot and analyze financial crime, investing in new and upgraded systems. For example, today we screen more than 689 million transactions across 236 million accounts each month for signs of money laundering and financial crimes. But we continue to refine our approach with the introduction of robotics and machine learning to improve the effectiveness of our payment filtering processes, increasing the volume of straight-through processing, thereby improving our customer experience, and also improving the effective use of our limited skilled resources that we have. We're also investing in and developing new technologies that we believe will enable us to make a significant impact on the fight against financial crime. At HSBC, we are moving away from the old approach of rules-based processes to use the power of data and cloud with machine learning and artificial intelligence to approach the problem in a new way. The vision of HSBC is something that we refer to as the Intelligence-Led Financial Crime Risk Management Program. It's for evolving our today rule-based method of compliance to an intelligence-led approach to financial crime management with data and analytics at its core. And this is an integrated approach, and the application and management of more sophisticated intelligence, we believe, will enable us to build a better real-time rather than a point-in-time picture of our clients and customers and the external trends and threats that we face. At HSBC, we are beginning to focus less on transactions and more on the customer, their behavior and their risk. From that and using the data, you can look at networks, for example. Ultimately assess the probability that a customer is poses a financial crime risk to the bank. We will also look to use this insight to continually improve the way that we identify and prevent financial crime across HSBC and apply it across all financial crime risk types that we face. In order to deliver on the ALF CRM, as it's fondly known internally, we are building a dynamic risk assessment to deliver this vision. The dynamic risk assessment is a cloud-based machine learning solution that seeks to identify financial crime risk at a faster pace than the traditional rules-based detective controls, with fewer unproductive alerts and a more accurate and sophisticated assessment of customer risk. We intend to the extent possible to use machine learning and artificial intelligence to harness all of the data that we have at our disposal, updating multiple data points dynamically, thereby allowing a far more informed risk assessment process focused on the probability that a client poses financial crime risk at a particular point in time. With the initial focus, and this is where it comes in, the initial focus for us is on the automated AML transaction monitoring side of things, and soon on the CDD, periodic activity reviews. The dynamic risk assessment and its output seeks to reflect a more accurate and precise identification of financial crime risk in our customer base. The aim is that we will also provide a faster identification of financial crime risk, as the DRA will shift us from the industry standard method of risk rating customers on a static 4-factor model at certain predetermined points in the calendar to an ongoing dynamic review drawing on a wider set of data points. Our aim is that this will happen across a number of different risk types, giving a more holistic view of customer risk while combining and aggregating a view of sectors, businesses, and regions. There are 3 dimensions to our transition from today's processes to DRA. First, as Brian mentioned, data. So data is bringing our data together in one place, and where possible and agreed by our regulators, obviously dealing with data privacy and data sharing restrictions, and also usage of the cloud. So once we've got that, we're going to put it in the cloud to ensure that it's easy to access and analyze, moving us to using dynamic near real-time data where possible and available. We need the processing power of the cloud to be able to run machine learning models on the sheer amount of data that we currently hold. The second aspect is analytics. We're looking at implementing advanced analytics to enable us to better analyze the data and carry out more granular risk assessments, learning as we go, failing fast, no doubt, and rolling out the best approaches that we can. And lastly is going to be the delivery. Part of the challenge that we see is then understanding how do we get the right information to the right people at the right time? How we provide those insights to the business and law enforcement in the best way. This will require a new operating model and end-to-end thought processes compared to what we have today. And we are certainly on that journey as we speak. So let me give you a little bit more detail on the DRA. So if we use transaction monitoring as an example, we can think of the current transaction monitoring systems as an old Nissan Tida or Ford Escort. And it has been running for a while and has been patched up here and then just there to keep it going. But it's not the most efficient car on the road. In the future, we see TM, transaction monitoring, as being an integral part of the DRA, hopefully more like a Tesla, but running efficiently on new technology, more streamlined and much, much faster. So you might ask, so what's the difference about this DRA model? Well, we use the analogy, it's got 4 pillars. We continue to use subject matter expertise, and this is where we incorporate our existing financial crime knowledge about typologies and suspicious activities, and we weight each of those typologies. Secondly, we look at outlier detection, and this shows the behavior in comparison to our relevant peers within that group. So just to give you an example, there may be a hotel paying in cash consistently every month. Because of the consistency, nothing would necessarily be picked up in a traditional transaction monitoring. However, when you look, all other hotels in that same jurisdiction region might be in decline, paying in less cash on a monthly basis, and this difference would be shown within the outlier detection pillar that we are looking at. Third, anomaly detection. So this looks at customers' behavior over a time, and it's a long period of time that we would look at given the amount of data that we would have, and would show them where their behavior had suddenly changed. For example, suddenly paying in large amounts of cash than usual and then netting this off. So a true kind of looking at it as real time as we can. In the current TM, the current scenarios would be poor at capturing this kind of typology. And we get hundreds of alerts that would be below the thresholds and too low and of no use. And lastly, we would look at it from a network perspective, because current transaction monitoring processes don't do this, or most of them don't. We'll show who our customers are transacting with. It will show where customers have been exited and where other customers have been interacting with them. So looking at close interactions, not looking at the entire population. And it will show, for example, where companies are linked by the same IP addresses or telephone numbers or general physical addresses as well. So the question you're probably asking and thinking, and so what happens next? Well, from a DRA perspective, we put the model looking across our data and against those pillars. It produces an output, which is and provides a risk assessment probability for each customer within that portfolio. A number is allocated, so a risk rating is given. And then once that rating has been provided, obviously the higher the number, the more probability that we need to look at a customer more closely. So that's a whistle-stop kind of tool, but clearly what I've just articulated is only a high-level overview of the ins and outs of this are far more complex. However, we believe that having richer and deeper knowledge of client features and behaviors not only allows better identification of financial crime risk and therefore more targeted mitigation action if necessary, but also supports improved law enforcement outcomes. It can also empower financial institutions to take on clients in certain business categories or jurisdictions that had previously been out of appetite due to a lack of data and assessment capability, which could contribute to enhanced financial inclusion. So whilst I've focused on a couple of examples of the use of technology in advancing our capabilities in better managing financial crime risk, we're also doing things in the regulatory conduct space. For example, we've recently launched Ask Compliance here in the UAE and across the region to streamline how our colleagues from the first line seek our input and advice. This has certainly improved our turnaround times. It is providing an audit trail of the advice, removing the need to search through emails to respond to queries, etc. The vision for this tool is to further develop this into a self-service tool, pardon me, using machine learning and artificial intelligence once the data set is rich and mature enough that would make it even more efficient and effective, and therefore allow our skilled resources to focus on significant and material risk matters. You will recall that I did mention the increased volume of regulatory changes that we are experiencing. You can all relate to the work that is required when we get them, i.e. a gap analysis needs to be conducted, we need to revise our procedures, we need to look at the new risks and associated controls that are associated with it. So what we're doing is we are working on a tool to link the rules and regulations to policy and ultimately to our risk control assessments, with the vision that it will make the process of dealing with regulatory change simpler and more efficient, and that therefore responding to the risks much quicker. So these technologies, we believe, will improve our ability to analyze, integrate, and use our data to manage financial crime risk with greater precision, provide better information to law enforcement, and in time, potentially lead to greater financial inclusion. It will certainly help us to protect the integrity of the financial system directly and provide actionable information to law enforcement. Pardon me. So what does this all mean in terms of the compliance professional of the future and the skills that we're going to need? We're going to need to be more than just people that can interpret rules and write policies. We need to help the business understand what they need to do, the risk the organization will face, and how to manage them in an increasingly digital world. So the way I see it, the first skill set, if you like, is the ability to embrace technology and understand data. We've just been talking about digital and all of the innovation, etc. So in order to be a good compliance officer, you need to understand data. You need to understand the technology that is available in order for you to be able to be the architect of any digital solutions from a compliance management perspective. You also need to understand technology and data because of the business that we support are moving to more digital channels. So you need to really understand that entire ecosystem. You need to have the ability to drive efficiencies and evolve with the organization. As I mentioned, and as we're all well aware, costs are becoming a challenge. Revenues aren't growing, and banks are changing their organizational structures. So the successful chief compliance officer will need to take an innovative approach to address how the compliance function delivers efficiencies on a continual basis, but continues to manage risk in an effective and efficient manner. The other skill set is to actually have a breadth of perspective. The strategic role or nature of the role means that a CCO must understand both the entire organization and the economic and geopolitical environment in which we operate. Having the bandwidth and judgment to anticipate the behavioral issues that may arise and the reputational damage that they will do to the organization and the wider industry is at the core of this job description. I think having an internal network and good relationships with other risk stewards is also key. We can't operate in silos anymore. We need to be able to actually operate cross line of business, cross risk, in order to actually deliver a good compliance management framework. And then lastly, I would say is obviously making sure that we have a good external network. You need to have a good understanding of what's going on in the market, in the region that we operate, and globally, so that we can actually look more at setting a forward-looking compliance agenda, managing the horizon risks, and trying to spot things and prevent things from happening before they do. So with that, I will conclude, and it remains for me just to say thank you once again to Brian and the team and to you all. I hope that you found it useful, and I will hand back to Elizabeth. Thank you.
Okay, thank you so much for that, Colin. And I'm really sorry, everyone, about our technical difficulties in the beginning. There's nothing like having a virtual event to make you find out where your technical weaknesses are. I think it was really interesting, Colin, especially hearing you talk about data. I think that's what we're going to hear more about over the next 2 days. It's definitely something on the top of our mind, as I'm sure it's on the top of the industry's mind. Now, on that note, I am going to introduce the next panel. We have a panel now to discuss efficient risk management through automation. I would like to introduce Lawrence Paramasavan. He's the director at the DFSA in the Policy, Risk and Strategy team. There we have Suhail Zabari from the Dubai Islamic Economy Development Center. We have Eric Hoffer, who's the co-founder of Starling. We have Paul Cairus, who's the head of FinTech, Blockchain and Emerging Technologies at PwC Legal. And last but not least, we have Abigail Marshman, who's the acting head of AML CFT Supervision Department at the UAE Central Bank. So on that note, I'll leave you in their very useful hands and hand that over to you now, Lawrence.
Great, thanks Liz, and good afternoon to everyone. And I've got the privilege of moderating this panel discussion, which has a list of esteemed panelists that cover very much the public and private sector. And our topic for discussion today is very much about driving efficient risk management through automation. And I'm going to kick it off straight away by going across to Eric Hoffer, who's the co-founder of Starling Trust. Starling Trust is well known to the DIFC. It was one of the first successful graduates from the inaugural DIFC FinTech High program back in 2017, a program that's continued to grow successfully each year. And so we're very happy to have Eric here from Starling Trust. And I'm going to ask Eric to touch upon a key area, operational risk and employee behaviour, and just how companies such as Starling Trust can assist in assessing behaviours and identifying habits that can improve risk management.
Certainly, thank you, Lawrence, and I really appreciate this opportunity. We've had a really great partnership with the DFSA over the years, and I'll also mention that as one of the more leading global regulators, the DFSA has been a regular contributor to an annual compendium that we put together of the new trends in culture and conduct risk management, and is always a great feature as part of that in terms of where where regulators are really going in the management of operational risk, and recognizing that managing culture, managing behavior is really, and getting at the root of these is critically important to getting ahead and managing operational risk. And of course, that intersects very much with topics around surveillance and monitoring, and that raises a lot of questions. We, I think it's really interesting that on this topic, I mean, the surveillance and monitoring really covers a lot of ground, and especially with digitalization, there's a lot more to monitor, a lot more to surveil, and there's a tendency to just, I think there's an over tendency for firms to try to just monitor everything, and without a really good reason, or without a clearly articulated reason of what they're looking for, and that can get people into a lot of trouble. And I think I'm looking forward to diving into some of those topics, and that's where a lot of concerns that people have around privacy, around intrusiveness come into play. And so we approach it in, we take a very specific look at what we do. So part of this comes from from our standpoint, we start from the principle that human behavior is a social construct. And so understanding the interactions among people is often far more interesting than what actions they actually take. There was a great example that I had many years ago in my early career. Somebody mentioned you're walking down the hallway and you see somebody with their feet up on their desk. And what does that tell you? Are they slacking off? Are they lazy? Or did they just complete a great deal and they're giving themselves a few minutes to celebrate? And that gets to the root of surveillance and monitoring. It's getting away from looking at what's a specific action that somebody's taken at a given moment and putting it in the context of them interacting with others in their organization and what they're trying to accomplish. And this context piece is really critical. And so we take a look, Starling in particular, we take a look at internal communication, internal data sets, and we compile those, mash them together, and we look for insights in that context that gives managers an idea of what kind of behaviors are happening in their organization, and whether those behaviors are good behaviors they want to encourage, or behaviors that they need to get ahead of and understand that are taking place. And this is really critical from the operational risks context, because banks are spending literally billions of dollars every year on trying to manage operational risk frameworks, 3 lines of defense frameworks and structures, trying to create ethical programs and cultural programs, and it's all with very good intentions and costs a lot of money. But the tools that they're using tend to be around surveys, online training programs, intensive interviews, and culture audits, which are very expensive and hard to scale. And so the challenge is that this can be really hard to actually embed the great behaviors in the organization. And people also tend to forget that one of the most important elements of embedding these good behaviors is just day-to-day human interaction. And so you take the our recent experience with COVID, and that day-to-day human interaction, the people looking over each other's shoulders and saying, hey, that's not how we do business here. This is the proper way to go about working on this. That's all gone. And then the fact that people are working from home, and a lot of those surveillance and monitoring tools that were originally built for purpose of people in the office, that's all gone as well. And so we're seeing a lot of companies investing and trying to shift and trying to understand and get their arms wrapped around this. And there's definitely a sense that there's a lot being missed. So I think that's kind of our perspective at the moment, and I'll stop there if that's.
Great, thanks, Erica. I think that provides a really good overview, and you're correct. Operational risk is a very important area, not just for institutions, but also regulators, and the use of technology to identify behaviours, and that can obviously assist in developing better risk management, risk mitigation frameworks. I might hand over now to Paul Carews. Paul obviously works at PwC and has the benefit of engaging with a lot of public and private sector stakeholders. And I'm keen to hear from Paul just around where you see some of the technologies and the demand coming from your clients in terms of addressing risk management issues.
Sure. Thanks, Lawrence. And obviously, I'm very happy to be here. So like any emerging technology, whether it's AI, blockchain, cloud computing, all emerging technologies, they come with their own legal risk. Let's take, for example, open banking and open finance, which is getting so much attention in the Middle East at the moment. You look at the use of API and how data is transferred between banks and fintechs, banks and technology companies. There's so much emphasis on how privacy is ensured when you're using, obviously, these APIs and these technology platforms, obviously, because the risk can be amplified in case there is a data breach or a cybersecurity incident. So that's why, we're seeing regulators, coming at an early stage and trying to encourage people to take privacy into consideration at the outset, and then ensure that privacy is embedded in the design of open banking. Another example, what we're seeing now when it comes to cloud computing, for example, again, if you look at the UAE, at the mainland UAE, there are no clear regulations or guidelines on using cloud computing, but there are certain regulations and certain rules that restrict transferring data to cloud services that are provided outside the UAE. For example, data related to payments, data related to healthcare, and governmental data, of course. And so the key question is, I think, to financial institutions and to fintechs is, how do you scale your business into a number of countries, for example, here in the Middle East or globally, while making sure that your technology and your operations are compliant? So again, there are serious legal questions that that can and should be taken into consideration at the outset. I'd say the technology is crucial. We're seeing so much large number of financial institutions and fintech using technology to manage the risk, but also the legal and regulatory risk is something that have to be taken into account at the outset.
Thanks, Paul. And just to follow up on those cloud sort of service areas, are you seeing more demand from clients to move there? And also, are they raising questions around where the regulation should be put in place that provide more flexibility around where the data is being held?
Yeah, absolutely. And Lawrence, I think it's a very good question. I think what we're seeing in the market is, again, increased use of new technologies. Take, for example, blockchain and obviously cloud services. Again, we're seeing a very, very large number of financial institutions and fintechs using cloud, for example, and also a decent number of organizations looking into blockchain. The key concern for these companies is that, how do I ensure that my regulator understands what I'm doing, and my regulator provides the right regulation for these type of new technologies? So again, you look at digital assets, you look at blockchain, you look at some of the machine learning. Decentralized systems in general are a bit challenging, and we're seeing this globally. Anything that is decentralized is quite there's a big question. We're going to wait and see how regulators they're going to regulate or treat these decentralized systems. But these are the type of things that we're seeing almost on a daily basis, in our conversations with our clients.
Okay, thanks, Paul. And I might now hand over to Abigail Marshman, who we're very happy to have. Abigail works with the AML unit, acting head there at the central bank, and financial crime has been an important priority for governments, regulators, financial institutions around the world, and in their fight against financial crime. And we're very happy to have Abigail here with us. We've been working closely, as many of the stakeholders know in terms of the FATF mutual evaluation, and it's nice to have Abigail here to touch upon what regulators are also doing in this space and how they're also using technology, subtech as it's called, and how they're going about using that in their supervisory programs. And so I'll hand over to Abigail, who might touch upon some of those initiatives.
Thank you, Lawrence. Thank you for inviting me, and to the DFSA colleagues and all the guests on the line. It's a pleasure to speak to you this afternoon. I'll maybe just start by talking about a recent initiative which we have embarked upon from a UAE central bank point of view, which I think illustrates the significant evolution in the use of technology for a range of purposes. As part of an effective financial crime compliance program, banks and other financial institutions need to have a robust sanctions risk mitigation and management framework in place. This typically would mean that they implement an automated screening solution to assist in the identification of sanctioned individuals, entities, and transactions. So once such a tool is implemented within a financial institution, the process typically becomes the primary alert mechanism and means through which an FI detects its sanctions risk exposure. Obviously, as a regulator, we become squarely interested in the use of these tools and these capabilities. And so on the flip side of an implementation of a technology within a financial institution, we as a supervisory authority need to have the means to determine whether or not those actually do what they seek to do. So our on-site examination processes have always assessed sanctions frameworks and systems within our licensed institutions. And we've historically always done this during on-site examinations, which is time-consuming. We can only do a single FI at a time, and we typically can test the capabilities of these tools on a sample basis. From a central bank perspective, we actually recently implemented a supervisory technology with benefits of deep analysis and assessing multiple financial institutions at the same time. So our recent project has launched a sanctions screening testing capability, whereby the first phase of the implementation, we succeeded in testing a total of 82 sanction screening systems simultaneously. We did this within a period of 48 hours, analyzing a matching capacity of each system against more than 3,000 sanctions records per system. So as you can see, both in terms of complexity and scale, the use of a supervisory technology has significantly evolved what we can achieve from a regulatory oversight perspective, and the yield that we can demonstrate in our capability to measure both adequacy of these controls as well as effectiveness of the controls. We are able to now understand whether institutions have commensurate resources in place to tackle the output of what these systems are producing, whether they are screening against lists that they opt to screen against in terms of either their legal obligations or their individual institutional policy. So the significant evolution that we've implemented by the implementation of just one SupTech tool has demonstrated the true benefit of what we can achieve through a proper calculated selection of the right supervisory tools that would enable, evolutions not only in our financial institutions, but also in terms of the coverage that we can achieve in our oversight responsibilities.
Great, thanks, Abigail. Yeah, clearly sanctions compliance is a very important area, and we'll be hearing after our panel discussion from Will Rich, who's going to be doing a demonstration on behalf of Karen. But in terms of the financial institutions that you're seeing, are you seeing that they also adopt different technologies in terms of managing their sanctions risk within the institutions themselves? And also eKYC solutions and that area where we're seeing a lot more eKYC solution providers out there in the market, and clearly there are some benefits and areas that institutions need to assess when selecting particular eKYC solution providers.
Correct, Lawrence. So, I mean, if you look back in terms of the focus of financial crime controls from a technology point of view within financial institutions, for the most part, the primary tools and implementations that we've seen have centered around retrospective analytics of transaction monitoring to look for illicit and unusual and suspicious transactions. And we're seeing a square shift in that now. We're seeing a huge investment into pre-fact and pre-execution technologies, analytics, robotics, around analysis of transactions long before they get to the point of repeated risk exposure for an institution. And so the traditional transaction monitoring systems that our institutions are familiar with, I think will fade away into a range of alternatives where the likes of machine learning rules and collaboration of historical silos of information that sit in various pockets within a financial institution, be it from a credit risk, operational risk, fraud risk perspective, have always run alongside but segregated from each other within a financial institution. The convergence of all of those data pockets now into a proper single client view with a layer of artificial intelligence mechanisms or analytical mechanisms that predict rather than look retrospectively at what has taken place repeatedly within an institution, I think put us instead to more meaningfully be able to disrupt illicit activities within the sector.
Thank you, Abigail, and we might come and touch upon a few more of those other areas that you're seeing shortly, but I'd like to actually pass across now to Sahal Zuberi from the Dubai Economic Islamic Development Center, and really keen to hear from Sahal in terms of the Islamic finance sector, and in particular how risk management is perceived in that particular sector, and how you're seeing automation and technology being adopted to address risk management issues.
Thank you very much, Lawrence, and welcome to the panelists, and especially Eric, because we met way back in 2017 when Eric was part of the FinTech Hive in the IFC, and we had met there. And it's really nice to know in the last 4 years you have achieved a lot, Eric. Well, coming to the subject, first of all, the risk management in Islamic finance is different from the perception that we generally hold on conventional finance, because I've been a conventional banker for almost 2 decades before I switched sides and I became the Islamic banker way back in 2001. So I've seen both the sides, and the main difference that I have realized is that the core Islamic financing principles, which have remained constant over centuries in this fast-changing world. So as we say that the only constant is the change, but here it's totally different. It's the Islamic financing principles which have remained completely constant over the last 14th century. So that is the mainstay for Islamic financing principles to prove their worth and then to go through the test of time many times. First and foremost is that in Islamic finance, the transactional odds must be evenly shared between the parties and not staked against one party, which is generally we see in the case of conventional finance. And we all know who that one party is, obviously the borrower. Secondly, and this may sound really strange to all of you, the inherent risks must not be eliminated from an Islamic financing transaction, since such an act may cause the transaction to become void from Sharia perspective. So instead of the elimination of the risk that I learned while I was part of the conventional banking, for 2 decades. Islamic finance teaches me that you need to maintain the risk within the transaction. Now, why is it so? Because Islamic finance does not deal with the lending or borrowing on interest, but it deals with the traded investment, which is the real economic activities. And you see that instead of one structure found in the conventional finance, which is a loan with interest, and hence all the focus is on combating the financial risk, as we heard from Lobo. In Islamic finance, you will find 4 sale contracts and 3 investment contracts to be applied based on the funding needs. So for example, if a client needs certain funding, then obviously you have to actually see what exactly is the need and how a particular contract can be applied on that. So every Islamic financing contract has a distinct risk paradigm separate from the other, such as credit risk, equity risk, performance risk, market risk, and so on. Well, coming back to maintaining the risk, this is to follow a principle that the gain is to be realized only when there is a risk of loss. I will repeat, the gain is to be realized only if there is a risk of loss. An easy example I can give is that, for example, a landlord cannot shift the ownership risk to the tenant, or the ownership risk to the inventory is held by the trader, or the equity investment risk in an enterprise will have to be held by the investor. So explanation will not be complete if I do not also mention the impermissible risks in Islamic finance, which must not be undertaken at all in a transaction, otherwise it will make it void. These are the uncertainty in the quantity, quality, existence, and delivery of the subject matter of the contract, besides the payment terms. So everything should be crystal clear. There should be no iota of any uncertainty. So you are taking care of the risks, all of these risks in the transaction. That brings us to the question whether it is permissible in Islamic finance to mitigate the risks, if not eliminate. So there are 2 things. One is that either you eliminate the risk, which is not allowed in Islamic finance, then you think of whether can I mitigate the risks. So the mitigation of the risk is definitely allowed, and obviously it is being done. And this is the area where automation can play a big role. And in fact, it is already happening. The innovation in Islamic finance that we see is 2-pronged. One is the innovation from the documentation perspective, and the innovation from the technological perspective. So innovation and risk mitigation from the documentation perspective include the promise to purchase in a Muraba transaction, promise to lease in an Ijara transaction, Islamic insurance, for example, called Takaful, Sharia compliant products for currency and rate hedging. And these are all documentation, and that's why you can mitigate your risk. But then when it comes to the technological or automation, there is a great potential that can be applied. The risk mitigation can really be made more efficient through the automation. And then I'll give you an example. And if you may have heard of this dot-com bubble way back in 1990, in 2000 actually. But in 1999, 1 year before that, Dow Jones came up with the Islamic index, Islamic DJIM, the Dow Jones Islamic Market. And what was it? It was based on the electronic Sharia screening of stocks. And then soon after that, there was the dot-com bubble. And the bubble was burst, and the world saw in disbelief that the WorldCom, Tyco, Enron, Northpoint, and so many other heavyweights crashed like house of cards. However, these companies were exited by DJIM long before the bust, based on the electronic Sharia screening, since they had breached the borrowing ratio. In turn, the investment in these stocks were liquidated by the Islamic fund managers, thus saving the Islamic investors pretty penny. So I think this is an excellent example of how automation can help risk mitigation in Islamic finance, if not risk elimination. The other areas of Islamic finance where automation is being applied for risk management is the capital market, where we saw, and basically in the FSA, we saw that the WITHAC held the pilot project for providing a complete platform for launch of the Sukuk and using the smart contracts. Starling is again an excellent example of providing tools for managing staff behavioral risks in financial institutions, and Colin talked about earlier. Similarly, the artificial intelligence used in the Islamic mutual funds has also caught the attention. And I'm currently advising one of the fintech hive startups who is actually using the AI to actually exit the losing stock on the spot and entering into the gaining stock. So it is really it's very, very exciting for me to see all this happening. And I'm very happy that, the risk management, not from elimination perspective, but the mitigation perspective, is actually getting a lot of support from the automation. Islamic financing principles are also very much akin to automation, since these are based on following a chronological order. And any disruption in that order basically makes the transaction void. So if you automate all those, there'll be a lesser and lesser risk for a transaction to become non-Sharia compliant. And when it becomes non-Sharia compliant, then obviously the Sharia auditors will discard the income and take it to the sort of charity, and then the financial institution will lose. So these are a few thoughts that came to mind that I thought, let me share with you. But this is totally different perspective when we normally see a conventional risk management technique. So this is a bit of deviation from that, I must say that.
Great, thanks, Sahel. No, it's really interesting to hear the different types of issues that are relevant to risk mitigation within the Islamic finance sector. I might just go back to the topic we were talking about within financial crime and obviously some of the risk management, but in particular areas such as internal fraud and market abuse. And I'm keen to hear from Eric a little bit too, just around how behavioural analytics and other automation can be used by financial institutions to proactively look at addressing those types of risks.
Certainly. So, from our perspective, there's been I think other panelists have mentioned that there's just been an explosion of solutions on the market to try to address issues around financial crimes and implementing new processes and systems, and that's absolutely critical to have better tools for analyzing data and finding those so the anomalies or the transactions that are outside of scope or don't fit other principles that have been set by the bank based on their best practices. But what's often overlooked is that the Bank for International Settlements and the banking and their standards organizations have pointed out that really operational risk has to do with systems, processes, and people, and it's that people element that is often completely overlooked or given short shrift, and that's also the hardest part to solve. You can have the best transaction monitoring system in the world that pulls in data from lots of extra third-party services and puts up a red flag. But what's key is how was that system configured in the first place? What happens when a red flag occurs? What's the escalation process? Who's going to be, who makes the decision to go to one of the bank's largest customers and make an issue of it and potentially harm a lucrative transaction? And at what point do those standard processes get overruled by the people who are running the bank? Well, yes, yeah, I know this transaction doesn't look really good, but let's just file a report, put a SIR together and send it to the regulator, and if they make an issue of it, then we'll do something about it. It's those kind of interactions, those behaviors that are really at the root of so many of the scandals that are taking place, and it's really hard for people to get good data on what's happening in the organization and how those behaviors are really taking place. And yeah, I mean, Sahel, we were talking about this 4 years ago. That's one of the hardest parts too with Islamic banking. There's such a temptation to revert to other uses when money's on the line, and trying to make sure that people have the things that Islamic banking has been talking about principles for 1400 years, that people are now just waking up with ESG and issues around corporate purpose. The rest of the world is starting to wake up and realize that these things are actually really important. but just as they're realizing that they're important, they're also, we have a long way to go to try to make sure that the behavior is keeping up with that and is able to hold that. So where we come in is just providing tools that allow banks to actually visualize some of those behaviors, visualize where those are happening at a much more global scale. And this one way that banks are using now to try to get ahead of that challenge.
Thanks, Eric. I'll just hand over back to Paul. I'm just keen to, Paul touched on the cloud sort of service area. In here, whether you've got any other areas where you're seeing clients have demand in terms of use of technology.
Yeah, absolutely, Lawrence. And I think the the key technologies we're seeing in demand in the market now are around artificial intelligence, machine learning, and again a little bit blockchain. But again, we think that blockchain has massive potential in the market, which is more or less untapped yet here in the Middle East. But on the machine learning and AI, I think it's important to differentiate between banks who are using AI to automate certain operations or certain processes and systems in place, and between when you see financial institutions and banks are using machine learning to try to predict more, for example, customer behavior. So you look, for example, there's a number of banks now looking at how they can use machine learning to enhance their credit assessment, and then also to look at how they can better allocate their capital to provide loans in a very efficient way. So banks, obviously, they have limited capital, and they're trying now to use this capital in a very, very smart way by trying to leverage the data that they have, right? So the question now here is, how can you use machine learning to try to predict your customer assessment, and in the future, to a certain extent, even future incidents, in order for you to better allocate your capital. So this is something that, again, is getting so much attention. There's so much work happening in this space. It's not about the technology itself. I completely agree with Eric. It's also about, what is exactly your business model, and where do you want to be in this spectrum, right? In the digital spectrum, if you will. How far do you want to go with by using AI and machine learning and try to predict? And also that's why looking at your data becomes extremely important, how structured and how organized your data is. So you've got number one, this AI machine learning. On the other side, you've got again blockchain. What we've seen in the blockchain space, we have seen a decent number of big banks. So this is JP Morgan in the US, HSBC, adopting certain blockchain platforms. So look at HSBC, for example. What they're doing now, they're using a blockchain platform for their trade finance transactions. Now, trade finance is document intense, lots and lots of documents, right? And lots of signatures required. What HSBC is doing, they are using blockchain basically, and in particular smart contracts, to try not only to automate, but also to standardize their legally binding agreements. And then therefore what they're doing, they are reducing the time that it takes to exchange and also verify these documentation from something like 10 days to 24 hours. And so there are use cases on how banks are using, for example, blockchain. Trade finance is a good example. JP Morgan, on the other side, they have their own platform where they've launched their own digital currency, JPM Coin. Now, the point behind this blockchain is, how can JP Morgan transfer money across the globe, right, almost on a real-time basis? And so we're seeing, again, people using blockchain for money transfer and for money remittance, especially for global banks. But I think the key point I want to make here is, and what is I think worth mentioning here, is that we're seeing a little bit the lines getting blurred between financial institutions and tech companies. Right. So if you look at what financial institutions are doing today, they're trying to offer personalized financial services, as opposed to the same loan for everybody. Right. So and this is where we're seeing some collaboration happening behind the scenes between some of the really big tech companies, right? Apple, Google, Amazon, with the banks and financial institutions, where they're trying to capture a segment all around how can we provide personalized financial services. And you look, for example, as new business models, right? Like banking as a platform, banking as a service. You look at this digital platform where you have all these parties, and they're coming and trying to provide their products, and financial institutions are becoming more like marketplace. So there's massive disruption happening here, and I think it's a matter of time before we see these new emerging models taking place here in the in the UAE and the wider Middle East.
Sorry, I'm just going to cut in there quickly, Lawrence. We are just about finishing up, but I'm just aware that there's just time for one question. I think you might have the questions in front of you, just to have a quick look and give someone the opportunity. Have you been able to open them? No. There's a little box that says questions, and if you just click on that, the down arrow.
Yep, got it.
Okay, sure. I'll give you just a couple of minutes, and then if we wrap up, because we'll get on to the demonstrators. Thanks a lot.
Sure, thanks, Liz. Yeah, so this question very much for Abigail, but I'm happy for others to jump in too. So what is the view just in terms of the CBUA regarding delivery of new laws and regulations to help put structure and framework on managing data privacy transacted through new technologies and systems?
Is that a trick question? Well, I think we need to separate out from the central bank per se to a national level what the laws and legal regime and evolution of the UAE will be when it comes to data privacy, because we would particularly be interested in controlling and mitigating the data privacy and confidentiality related to the financial profile of a customer, whereas in relation to the UAE, I think the federal laws would be much more overarching and much more extensive in terms of holistic data privacy and confidentiality. What we are seeing is more and more appetite for the use of cloud technology within the UAE. For the moment, though, we see that while there is encouragement and seeming consideration to endorse and allow the usage of cloud-based technologies and platforms, at this point in time, there's still a very cautious approach towards safeguarding data within the UAE and ensuring that data that is held by a number of different institutions and organizations for various purposes is retained within the confines of the jurisdiction of the UAE. And so usually the due diligence around the implementation or procurement of a certain application or platform is considered in the context of actually where that cloud is hosted, or who the incorporation or the registration of the service provider or the vendor in which jurisdiction they sit, and what that counterparty jurisdiction's legal framework looks like in terms of data access and confidentiality as well. So these are some of the considerations which are at play at the moment. I don't think I squarely answered the question, but I don't believe that I'm in a position to give you a holistic view on behalf of the entire UAE. But I tell you that, it's something that we, from a federal authority perspective, also contemplate and also face a dilemma with, because there are a number of capabilities which we ourselves wish to implement and explore that leverage the usage of cloud, and we find constraints and limitations there. So I think, from a UAE government strategy point of view, there's a deliberate digitization strategy at the UAE governmental level, and encompassed within that digitization strategy, I foresee that there would be a clear policy position being taken in the future around the usage of clouds based technologies. I suspect with constraints and conditions around where that data can be hosted and utilized.
Thanks, Abigail. I really appreciate you tackling that question. And no, you're right. Very much there is a need to have harmonisation of data protection regulations across the country. We've obviously seen the DIFC recently updated its DIFC data protection laws, and again, that's been very successful, but ultimately it does rely on harmonised requirements across the country for there to be more certainty for businesses to adopt new technology and be able to understand exactly how it can use and process data. Now, I think we've unfortunately come to the end of our time that's been allocated. I'd like to thank all panelists for taking their time to participate in this. I know that they're still available and around, and if you have any specific questions that you want to raise to particular people, you can do so. But thank you once again, and I'll hand over to Liz.
Thank you.
Okay, and I just want to reiterate what Lawrence said. Thank you all so much for joining the panel today. Definitely interesting, and again, another theme coming through, just the use of data, the value of data, how data is properly protected, and the value that it has going forward. Is obviously something at the DFSA that we're thinking about, and you'll hear more from us tomorrow about that. But I'm aware of time and we'll have to keep going. Now we also have our RegTech solution provider demonstrations. We've got two RegTech providers today. We've got William Rich from Caron, and we've got Eric Hoffer, who you just heard from Starling. Now, they are going to be able to answer questions, I hope, during their 15 minutes presentation, but if not, they're going to be able to respond after their presentation, and they will be able to engage with you on a bilateral basis. Now, the usual thing that a regulator needs to say, just be aware that any of the participations by these demonstrators doesn't constitute an endorsement or recommendation for their particular product or services. We're not responsible for any of the information presented. We are just trying to give you a flavour of what types of products and services are available to you in line with the theme of what we've got for today's event. So, without further ado, I want to introduce William Rich. He's the Managing Director for Caron Middle East and Africa. Caron are a research, technology and data analytics company. They're focused on understanding and managing sanctions and export control related risks. At Caron, William manages the firm's Dubai UAE office and globally leads the firm's activities in emerging markets. He also manages Caron's global partnerships with governments, regulators, and the US National Laboratory System. So over to you, William, and thank you very much.
And hopefully everyone's able to see the slides that I've just put up. It should just have our name, and I'll jump right in since time is limited. So first, a big thank you to the DIFC Authority and DFSA for having us here today, and for everyone on the line who are giving us your time and attention today. As Elizabeth mentioned, I'm Will Rich, and I work for Caron, which is essentially a data company. And so I'm glad to hear everyone talk today about the importance of data. And I manage their UAE office, which is currently based in my spare bedroom. So I was previously based in the UAE as the US Treasury Attaché here from 2015 to 2018. And today I'm going to take you very quickly through who we are at Caron, what we do, and how our clients, who are some of the largest financial institutions and corporates in the world, use our data. And then I'm going to take you through a very brief demo of one of our tools so you can get a sense for how the data works in action. At Caron, we have teams of specially trained analysts that research the networks surrounding individuals and entities targeted by national and international sanctions and export controls. We build custom data sets that can be used in investigations and automated screening, and to train machine learning and artificial intelligence. We were founded by former senior Treasury intelligence officials that were dissatisfied by the commercial data offerings available and how exposed to potential sanctions violations they left banks and companies. At Charon, we capture data not just on sanctions or export controls, but also the underlying national security and foreign policy threats that they represent. Because of this, we can dive deeply into networks of illicit activity and put our research into databases and tools that our clients can use to manage risk efficiently and effectively. In its simplest form, what we do at Charon is help our clients understand the difference between this and this. The first slide had what appears on national and international sanctions lists, a single entity and identifying information represented by the red dot. Charon's expertise fundamentally is identifying the supporters, facilitators, and really anyone with a material connection to a sanctioned party, so that our clients can understand the broader network. What appears on these sanctions watch lists is really just the tip of the iceberg, and at Charon we show you what lies beneath the surface. I'm going to take you very quickly through our research process so you can understand why it's so important and so hard to get this right. Essentially, we use the same methodology that we use to target sanctions at the Treasury Department to now understand networks around sanctioned or export-controlled actors using only open source information. It starts with looking at a company or individual that has been targeted by sanctions or export controls, and in this case, it's a company. We then research everything that the sanctioned company owns at every level down to 0 or even an unknown percentage. We will follow those ownership chains down as far as they go. And this is essential because of the 50% rule that the US and European Union have, which state that anything that is 50% or more owned by a sanctioned company is itself sanctioned, even though it doesn't appear on any sanctions list. So there are literally thousands of companies out there that are technically sanctioned and carry the same penalties as listed actors, but don't appear on any list and present critical challenges to risk control frameworks and reputations. These ownership stakes can be outright, or they can be broken up over multiple small stakes, owned directly or indirectly. It's really difficult, and frankly, we're the only ones doing it right now. We also look upstream at companies that own sanctioned companies. It's not illegal to do business with someone that owns a sanctioned company, but that's something you'll want to know before you start doing business with them, and they won't always be forthcoming about it. We also figure out who all the senior leadership figures connected to the company of interest are: board members, executives, senior managers, and everything they own. That's because they can be links to broader networks of illicit activity. We also know that just because a company gets sanctioned, it doesn't mean the illicit activity stops. Sometimes the same people walk away from the sanctioned company and use another one to do the exact same thing. And this is where our research gets really unique. We actually analyze the entire supply chains of all sanctioned companies: contractors, vendors, investors, creditors, agents, and representatives. Basically, we'll find any material commercial relationship. And again, it's not illegal to do business with any of the companies in purple on the right, but it's extremely relevant to know whether a client, counterparty, or partner does business with a sanctioned actor, because that activity could expose you whether you know about it or not. So it's better to know. As you can see here, we also research the close business associates and family members of sanctioned individuals. We're not a service for politically exposed persons data, but when we detect that a family member or close business associate may be acting on or behalf of a sanctioned party, we'll track them too. Similarly, we'll follow related corporate entities as they evolve over time and shift from jurisdiction to jurisdiction to avoid internal controls at banks. When governments or the UN issue sanctions, they release identifying information about the targets, including things like physical addresses, phone numbers, dates of birth, and passport or registration numbers. We will enrich this data with virtual currency wallet addresses, IP addresses, and internet domain name registration information, as well as traditional identifiers that the authorities missed or couldn't release for legal or operational reasons. We will then run all of that information across the other information in our system and that we have access to see if anyone else shares the identifiers, so that we can look into those other parties to see if they're part of the broader network. We also spend a lot of time on maritime networks, and I don't really have time to dive too deeply into it right now, but maritime shipping is the preeminent way of evading sanctions and export controls these days, and understanding the networks of individuals and companies surrounding illicit maritime trade is essential to detecting, understanding, and disrupting. Now, I'm sure you've all been asking yourselves, okay, but where are you getting this information? The answer is that everything that we do is open source and put together by hand by expert analysts. We don't do automated scraping so that we can guarantee the quality of the data. You can see some of the source types here on the left, and we try to be as exhaustive as possible, conducting the research in more than 25 languages and over 100 jurisdictions worldwide, basically anywhere that we can get access to. We're extremely rigorous and totally transparent about where and when we get our information. The goal is to be able to enable our clients to make decisions with the best open source information available and to defend those decisions that they make based on our data to their boards, regulators, and if needed, in a legal proceeding. Our clients access all this useful information in a variety of different ways. Most of them take bulk data exports from us and feed them into automated screening systems to screen transactions, accounts, and potential clients or vendors using Charon data to identify individuals, entities, or relationships of concern. When they get a hit, we have a web-based search tool called Clearview that allows our clients to quickly look up a party of interest in our system and within seconds determine whether it has a connection to a sanctioned actor and the nature of that connection. This tool can also be used for investigations. We also do specialized research and training and have a multimedia outlet called the Charon Brief that is free and you should all sign up for. Because it's not very interesting to just display data, I'm going to shift right into a demo of our Clearview tool so that you can see the data in action, and hopefully we'll have time to get to a question or two at the end. And if you'll give me a moment to switch over there. Oops. So hopefully you will be able to see my screen now. What I have on the screen is our Clearview tool. And as you can see, it's an incredibly simple interface. There is a search box here that you can type the name of a potential client, counterparty, or partner. And I picked an example, a technology company based in the Netherlands called Microneat Microtechnologies. And as I type, you can see that it quickly narrows down the data in our system to identify this company. And I can click on it here and make sure it's the right Microneat, because obviously they're companies with very similar or even the same names all around the world. I can see here, based on some of the identifying information listed, that this is the company that I'm looking for. And the fact that it's in Charon tells you something from the get-go. We're not in the business of trying to capture information on every company in the world. The companies in Charon have a relationship, directly or indirectly, with a sanctioned party. And so I'm going to plot it into my workspace here. And the first thing to notice is that it's represented by a purple node or dot. Purple signifies that it doesn't appear on a sanctions watch list. And that is relevant. And I'm just going to make the screen a little bit bigger. So as I click on Microneat, you can see the research process that pops up, and all the identifying information, activities, business associates. But what also pops up are sanctions corridors. And a corridor you can think of as a pathway between whatever you're looking at and a sanctioned party. And so we can see that Microneat is connected to 31 different sanctioned individuals or entities. And when I click on that to take a look, we can see a number of firms, and we actually have an algorithm that puts the most relevant relationships up at the top. And so I'm going to start at the top with this company called Behaviour Technologies. And we can see here that Beijing Alight, there are 4 different pathways between Microneat and Beijing Alight. And I can get a little preview by hovering my mouse over them. Generally speaking, but not always the case, the shorter the pathway, the stronger the connection. And so I'm going to plot this 2-degree connection, meaning that there's one intermediary between Microneat and a sanctioned party. And I'll just make that a little bit bigger. And we can see at the top of this little network diagram is Beijing Alight Technologies. And if I click on it and look over to the left, first we get all the information about Beijing Alight, including its leadership and management, facilitation, support networks, and financial relationships. And we also get all the information released by the government when it was sanctioned. And if I scroll down, I can see that it was sanctioned by the United States in 2006 under the Weapons of Mass Destruction and Iran executive orders. For context, we always include a snippet of the sanctions press release so you know why something was sanctioned. And in this case, Beijing Alight was part of a network that was providing Iranian missile organizations with missile-related and dual-use components. But it's not just the entities in here that you're going to be interested in, it's the relationships between them. And so I'm going to go and click on this ownership relationship between Beijing Alight and another company called Beijing eScience. Looking back over here on the left, we can see that Beijing Alight is a 99.97% owner of Beijing eScience, which under US law makes Beijing eScience effectively sanctioned. The term of art is sanctioned by law. It doesn't appear on a sanctions list, but has to be treated as if it did. Now, where did we get that information? You can see here that this information is current as of December of 2019, that it came from a Beijing eScience annual credit report that was filed in the Beijing Administration for Market Regulation and translated from Chinese. Here on the left, under citations, you'll see all the sourcing that we used in this relationship. And you can see that we first ran across Beijing eScience in 2016. We updated it in 2017, 2018, 2019, and most recently, about a week ago. So, the first thing here is that Beijing eScience is a sanctioned by law entity, and we have that it has a vendor relationship with our company of interest, Microneat. When I click on that vendor relationship, we can see that Microneat, which I should say makes a variety of technology that could be dual use and problematic, go into a sanctioned by law entity. This is just their website where they advertise some of their tech. So when I look back at that vendor edge, we can see that according to Microneat's own website, accessed about a week ago, that Beijing eScience in China was a distribution partner of them. And we can see on Beijing eScience's Chinese language website that they provide microfluid cores from the Dutch company Microneat, which are used in machinery. So this is a potentially problematic relationship, and we actually found in an old version of the relationship that, an old version of the Beijing eScience website that they were marketing all sorts of other Microneat technology. And you can see all the citations used, and we cache everything in case it gets pulled off of the internet. But this type of a network will mean different things to different people. At Charon, we're not in the business of providing conclusions. All we're going to do is tell you what information is out there in the open source. And for different clients, they're going to derive different risk typologies from this. So if you're a bank in the Netherlands and you're providing Microneat, a mortgage for a warehouse, this is probably not a huge concern. However, if you are looking at Microneat and potentially going to be processing international transactions for them that could benefit Beijing eScience, this is a big problem. Additionally, if Microneat is going to be part of a broader supply chain for you, this is potentially problematic if Microneat could be removed for sanctions reasons, or your technology could be in turn leaked to Beijing eScience. So we're not saying any of those things are happening. We're just making you aware of these relationships so that if you were talking to Microneat about becoming a client or partner, you could ask them about this relationship, and they may come back and say they have a license from OFAC to do this activity, or they don't actually have a relationship with Beijing eScience. They used to and stopped and hasn't been removed from the website. Those are all possibilities, but what we want to do is present the best available open source information that can be found. And so I think with that, I'm going to stop, and if we have any more time, take a question or two.
Thanks, Will, for that. I'm really sorry. We actually have run out of time for questions, but that was really thorough, that presentation. Definitely interesting things there. If anyone does want to talk to Will, you can do a private chat or private questions with him now. But we're going to have to keep moving on, and I'm going to introduce our next demonstrator, Eric Hoffer, who you've met earlier on the first panel. Eric is representing Starling, and he is the co-founder and COO. As you heard earlier, it's a behaviour sciences technology company that helps firms manage their culture and conduct risk. So I will pass that over to Eric now. Yes, your presentation is up. So Eric, over to you. Thank you.
Thank you so much, Elizabeth. And thank you again for this opportunity to share a little bit about what we're doing here at Starling. What we focus on at Starling, we focus on this challenge of operational risk, and unfortunately, this is a challenge that continues to plague banks. And this first slide really kind of summarizes this. This came from a quote from the past chairman of NAB. It applied to a number of scandals that took place in the Australia market, but really this story has been written and rewritten many times in many jurisdictions across the globe. And unfortunately, too many times, operational risk challenges are only discovered after something has happened. And you know, a lot of after the global financial crisis in 2008, you know, people started to recognize this and started asking these questions. You know, there was the question of whether banks were too big to fail. And then, you know, people quickly started asking, well, maybe banks are just getting too big to manage. And regulators are sort of starting to echo a little bit of this, and they're no longer content with this regime of waiting for things to happen before stepping in with penalties and sanctions and those responses. So you're seeing we at Starling, we compile an annual report called the compendium. We call it's a compendium of trends, of updates reported by regulators across the globe. The DFSA has been a contributor since we first started publishing this 3 years ago. Our fourth edition is coming out in a few months, in the beginning of 2021. And what we've documented over the years is just a steady increase in regulators turning to senior managers' accountability regimes, where they're holding managers directly, personally liable for when things go wrong in their watch. And they're moving forward with mapping of, you know, requiring banks to provide accountability mapping. And it's the expectation is that if you don't know what's going on in your business, if you can't anticipate that something is wrong, then you're going to be held responsible. There's also a very interesting trend and banks are turning more and more to, you know, regulators are looking very closely at just management frameworks and governance frameworks. And we're seeing this also echoed among investors requiring greater disclosures around ESG, and particularly the governance element of ESG. There's a recognition that if you put in strong management and governance structures, then and processes, then you'll have a much better, then by definition, you're going to be able to manage these operational risks much more effective. But that's a lot easier said than done. You know, putting in place a 3 lines of defense framework, implementing a strong or announcing a strong risk culture program is a lot different than actually ensuring that those things are embedded in the organization. What's challenging is this understanding of human behavior, and this is another, you know, good example of the difficulties of managing large organizations and being able to get to this root cause of Are the people exhibiting the right behaviors? Are they demonstrating the right behaviors? And how can I evidence that to regulators, to my investors, to the board, and to other stakeholders that we're putting in the right programs and policies to manage behavior in the organization? And that brings us to where Starling fits into this ecosystem. So banks have tried to get at this in a number of different ways. Two main categories. One is, sort of the culture element, looking at culture consultants, culture audits, ethics training, surveys, all very important in their own way, but they tend to be very expensive. This is not something that's scaled very well. Companies can do more and more, for example, the HKMA last year, in the past 12 months, had directed all of the banks in the jurisdiction to conduct culture audits, and was very insightful, very helpful. But in the end, it's not something that you can do necessarily every few months. It's an enormous commitment of resources. And so and it can be very subjective and difficult to maintain on a regular basis. The other main source is to look at compliance, surveillance, and monitoring, and other tools, traditional tools, which get to looking at the systems and processes. And the challenge there is that while that can be more automated and more scalable through monitoring internal communications for keywords, or looking at transaction surveillance, too often you're finding problems after the effect, after they've taken place. And so they tend to be backward looking and can be intrusive and also difficult to manage. Starling gets in the middle of this, and sort of bridges the gap between being able to look at your culture in a regular and ongoing basis at a scaled scaled manner, while then being able to, and which gives you the ability to operate with more foresight, to look at the root causes, to be able to identify what are those behavioral patterns that are driving the misconduct or the operational risk breakdowns in the first place. And that's essentially what Starling provides, predictive behavioral analytics. And banks are doing this right now with customers. I think previous panelists and have pointed out, banks are already looking at customer transactions. They're looking at trying to predict customer behavior or customer fraud, driven fraud, using AI to predict those problems. Starling essentially does the same thing, looking inside the company. Take a number of different internal data sets and collide them together to provide insights. The three main categories of information we pull include organizational employee data. That's essentially, you can think of this as the formal organization, how it's meant to work on paper. Then we take a look at e-com's metadata, and we don't look at content. We avoid privacy concerns, and we also and some other byproducts of trying to read people's information, read content. We just look at metadata. So the two from back and forth, the sort of patterns of communication among employees. That gives us a picture of the informal organization. It's basically how things actually get done in the organization. And this is where real critical insight comes. The third piece comes from the governance and risk platforms. It can also go from performance indicators. Essentially, this is what the firm is concerned about, and that provides context. So, in particular, and I'll give you a case. I'll walk through a case study that for a project we conducted with HSBC. By identifying what the organization and these teams of people are trying to accomplish, and then putting it in that context, suddenly very interesting and insightful and actionable insights can be derived about the behaviors that are taking place. And these are behaviors that are helping to achieve the goals that the bank is working towards, or perhaps some of the behaviors that are working against that and making things more difficult. I'm going to talk a little bit about work that we did with HSBC, and this became actually the subject of a business case study by Harvard that dives into this real challenge that banks have with managing operational risk. And it's going to focus on the 3 lines of defense, which is pretty common across lots of banks. So in context, HSBC had been, for about 7-8 years, HSBC was, after a series of different issues, HSBC was caught in the U.S. market in a major money laundering scandal involving Mexican banks and Mexican customers. And as a result of that, the monitor was put in place, and a whole series of requirements were placed on the bank. They were suffering from, severe reputational risk, and so the bank had to invest in a new operational risk management framework. And our customer was the global head of operational risk at the time, and he came to us with this problem. The bank had already invested several $1 billion in a new 3 lines of defense. And just to touch on that, 3 lines of defense framework is quite simple. The idea is that you have first line executives who manage the bank, second line leaders who manage risk and compliance, and then the third line is your audit function. And they invested all this money to create new roles and responsibilities, hiring thousands of new executives and assigning new roles and reporting relationships. And they got to the end of putting this all together, and then there was a question from the board and from regulators, okay, how is it working? And our customer, who managed this whole process, had to turn to us and say, honestly, I'm not sure. We have surveys that tell us we're doing well, and town hall meetings, and we have all this, and a brand new process management system that's reporting on this on a regular basis. But on a day-to-day basis, we're still seeing gaps, and we can't really be sure that this has really been embedded in the organization. So we came in and we analyzed the informal organization. We took a look at how it was meant to work and then how it was actually working in practice. And we detected signals in this communication data that were consistent with teams that were effective and the teams that were struggling. And so we could actually paint a picture of the whole organization and visualize for managers what were those, on one hand, what were the key behaviors that were helping the bank to manage these risks. And then also actually be predictive, because once we started seeing those signals appear in the communication data, we could give management a heads up that, when we've seen these signals before, we've had declines in control environments. We've had a breakdown and reduced effectiveness of your risk teams. And so this allowed them to be much more proactive, not rely less on staff to catch these problems, and basically to scale their systems at a far greater, far better way to find these problems. I'll give you a couple.
I'm just going to jump in there quickly. We've just seen a question has come up, and I'm just aware that we haven't been able to answer as many questions as we'd like today. Have you been able to see the question on your panel at the side?
There we go.
Great. And I'll just give you that, if we could wrap this up in the next couple of minutes so we could get on to the last panel. Thank you very much.
Absolutely. No, it's my pleasure. The question is, how much do institutions really want to know about employee behavior? When something really bad happens and you've been actively monitoring staff, it becomes hard to claim ignorance and say we could not have known. That's always an interesting question, and I think it's people are starting to realize that that's sort of an approach that you're best not knowing what's happening to avoid the appearance of lack of competence or that basically regulators are no longer accepting that. The expectation is if it's happening, you should have been aware. And so really banks are starting to wake up that they can't continue to rely on process tools or standard just red flag chasing or producing suspicious activity reports over and over again, only to avoid addressing the key underlying behavioral proclivities of their employees. And so, this is what we're doing is inserting a new way of helping banks to really understand how their organizations work and where are those blind spots before something goes wrong, so that you can actually get ahead of the problem and address those proactively. And I guess that's probably a good place to wrap, Elizabeth. Unless there's another question, be happy to respond to that after. Elizabeth?
Right, sorry about that. My technology again let me down. Thank you very much for that, Eric. And I'm really sorry that we actually have run out of time here. As I said before, if you want to get in touch with Eric, the chat function will be able to work and you'll be able to ask him some more questions. So thank you very much for that.
All right, thank you.
Cheers. Okay, now we're getting through the day now, and I'm going to introduce the second panel of the day. It's around COVID-19 and the impact on regulatory compliance. The moderator for this panel will be Emily Southern from DLA Piper. She's a legal director there. She'll be joined by Ajaz Ahmed, who's a partner at Deloitte. She'll also be joined by Caroline Njiji, who's head of conduct and financial crime and compliance at Standard Chartered Bank, and then also by William Rich, who's the Managing Director at Carroll Middle East. So thank you very much for joining us today, and I'll hand that over to you, Emily.
Thank you very much, Elizabeth. And I wanted to start by saying good afternoon, and thank you very much to the DIFC and DFSA for inviting me to moderate this panel session on COVID-19 and the impact it has had on regulatory compliance. And I'm looking forward to discussing this with our panelists today, particularly keen to hear their views on the challenges that they have faced within their organizations, how they've dealt with those challenges, and keenly interested in how they plan on moving forward actually with all of this in terms of lessons learned and future proofing, so we can try and help ourselves better next time round, if there is a next time round. Fingers crossed there won't be. So I thought what might be nice if we start with one question for each of us around what you would say has been the biggest impact to your organization or the financial services industry as a whole as a result of COVID-19 and in terms of your regulatory compliance obligations. So perhaps, Caroline, I'll start with you.
Thank you, Emily. Thank you for the introduction. In the interest of time, just digging right into the question. From an FI perspective, we definitely saw a raft of regulatory changes coming from the key regulators, mainly from a prudential perspective, and we needed to react very quickly. Some of the biggest impacts in and around that was how we ensure that these fair standards applied across our entire client groups. We also found that some of our clients, because they multi-banked, not just within the UAE, but internationally, they too were being faced by similar requirements globally by other regulators and how they can manage this alongside what was expected in the UAE and in the DIFC. Subsequent to that, we also noticed that we did need to get quite flexible in and around client due diligence very quickly. We needed to not just focus on the financial services regulators, but also other regulatory bodies, especially those that look after the IDMV aspects of entities and individuals, you know, things stemming from identity documents, not being able to renew those, trade license not being able to renew that either. So we had to be really flexible in and around that with clients. Here in Standard Chartered as well, we luckily have been working on having several digital banks in our Africa market and in Asia, and therefore there's a lot of technology aspects to leverage off. So in terms of working remotely and being able to respond quickly to demands, not just from the regulators, but from our clients and other important stakeholders, was pretty swift. I would say the last challenge in and around this was how to keep the data safe and making sure that our clients felt that the data was being maintained in a safe fashion as we made these very quick changes. Reassurance, obviously, from a client perspective is really important, but also having very clear internal measures for our employees on how to handle the data as people moved from working in the office to then working from home, and how we maintain a very sort of strict control framework in and around that, and our monitoring process for that as well.
Thank you very much. Thank you. There's a lot there. Thank you. That's very interesting. And over to you, Ajaz. I think from your perspective, it'd be really interesting to understand what the challenges you have seen either within your own organization of advising your clients across the board, or perhaps amongst your client community. We can't hear you, I don't think.
Can you hear me now?
Yes, perfect. Thank you.
Okay. Good afternoon, everyone. I would say that what COVID-19 brought to the scenario was really what every risk professional and compliance professional have always been talking about, which is it really brought the business continuity planning, BCP, as we call it, in action. Not just for a organization. I think it's just that BCP probably got activated for the entire industry, be it regulator, be it customers, be it consultants, be it banks and other FIs. It got implemented almost at the same time and the same scale. And I think that brought, that was one of the biggest challenge which everybody was practically trying to, go through the change and adapt to the change. The second biggest impact that we have seen is what I call as the number of regulation and the speed of regulation. From my memory, I don't think we have ever had a situation in financial services where regulators, both financial and others, had issued a huge number of regulation in such a short time, because the regulators and the industry were trying to, react to the situation, which was quite fluid and evolving, be it in terms of providing economic stimulus packages, be it in terms of providing, sending new data requests, assessing what's the stress impact at a micro level or at a macro level. So those are the two major challenges that we really had seen.
Thank you, Ajaz. And Will, to you, same question.
Sure. Thank you, Emily. So, at Caron, we're a technology company. We were already pretty distributed anyway. But, what we noticed in our clients who, were the financial crimes compliance portions of banks, compliance portions of corporates, and then a number of the big global tech companies, what we saw was really just an accelerated shift to automation. And we had been part of a number of projects that were on 2-year, 3-year transformational timelines that got squashed down to 6 months. We got incoming inquiries from a lot more financial institutions than I think were even on our radar, because there was just an efficiency argument to be made. If you are only able to have half your staff in the office, you have to get more out of them. And having new data, new tools to allow them to do the KYC operations, enhanced due diligence, investigations, and screening more efficiently, because although staffing has dropped pretty significantly in financial institutions in the office, there was a downtick in transactions that has ebbed and flowed. But generally speaking, transaction volume has been pretty high during this whole time. And so the compliance obligations, they don't go away just because people aren't in the office and don't have access to all the tools that they used to. And so the big push towards automation and trying to really find comparative advantages where you can use technology, you can use data to minimize the need for human judgment calls and save those only for when they're absolutely necessary.
So on the one hand, these are challenges that you've noticed, but would you agree that they're also the trend? Is there anything else there? You've mentioned automation, the speed of which all of the automation has been rolling out, accelerated timelines, a lot more regulation. Are there any other trends that you've noticed?
Yeah, so this is really, I think COVID was more of a catalyst towards change that was already happening. I think, one of the things that, is sort of difficult about the COVID situation is there were essentially 3 parallel trends or parallel tracks of trends going on at the same time. You had the regulators who, as Ajaz noted, were issuing regulations in just an immense amount of interpretive guidance. Every regulator in the world was issuing COVID fraud, COVID cybercrime, COVID, you name it. You had the financial institutions that are trying to, create organizational change and operational change and sometimes policy changes as well. And then from the threat perspective, you had a lot of changes due to COVID there where, we're a data company that looks at the threats. And so, what we were seeing were, Uyghur concentration camps that were manufacturing masks, ISIS finance, financiers in Turkey that were marketing masks online and other PPE online, and then sanctioned Russian companies that were manufacturing ventilators that were being flown all over the world. So I think what's so difficult is there were just a lot of trends all going on at the same time, some of which were accelerations of more in-depth regulation and more sensitivity to things like cybercrime and fraud, as well as technological transformation, and then just financial crime getting more complicated because the adversaries were being opportunistic with some of these money-making opportunities.
Thank you, Will. And Caroline, from a bank's perspective, dealing with the regulators, I imagine virtually over the past several months, how have you found that? Have you found that's worked virtually? Any feedback on that?
Sure. Thanks, Emily. It's actually been very smooth for us. Not saying that because this is a DFSA event or anything like that. It's actually the truth. Because technically, in a normal working environment, we don't meet with the regulator face to face in any case on a day-to-day basis. So we utilize every other tool that we have within the organization. I think the biggest difference came when we needed to have the on-site, what we call the on-site visit, which technically the regulator would come into the premises and would be there for about a week or so. In some other markets, they would be there for several weeks. And therefore, we've had to be a little bit more innovative as to how we do this. The tools such as what we're using right now is technically what we've been working on, making sure that we can compile the data and have it sent in a secure manner to the regulators. was really important. We already do that though, with or without the pandemic. And also when it came to the interview sessions that the regulators usually undertake, again, we had those done virtually. And at times it did work better for us for those instances where people did not need to travel to the UAE and they perhaps needed to meet with the regulator. So it actually made it more seamless for us over time, and we're pretty much now used to it.
That's great, thank you. I was just interested, that's good feedback. Ajaz, the next question's for you, and from your consultancy perspective, I just wondered, in terms of advising your financial services clients, what you see as their greatest challenges in implementing these tech solutions as part of a digital transformation journey, and why you view these as challenges for them. Sorry, we can't hear you.
Can you hear me? Yeah, apologies. So I think the most important focus is, the first item is, what's the problem that we are trying to solve? Clients need to keep in mind that it's not the technology problem that we're trying to solve, it's actually a business problem that we're trying to solve, which brings me to the first point, that any financial digital transformation project, for it to be successful, all the stakeholders need to look at it as a business problem with a business focus, and not just as what's the kind of technology that we need to bring in and how do we bring in. We have seen a lot of technology transformation projects fail when technology starts becoming the focus and the business becomes the secondary focus. So our suggestion is that, if you're trying to, implement digital transformation, please, the first and the most important objective is to make sure that all the stakeholders within the organization are aligned on the business problem that's being solved, and it gets looked at that way, in terms of the planning, in terms of staffing, in terms of how you go about solutionizing. All that needs to have a business focus. The second major area that we have seen as a potential challenge is what I call as the employee pushback. We are all humans, end of the day, and the humans are used to doing their running the business operations in a certain way that they have got used to. And one fine morning, if you try and say that, okay, we're going to bring in technology and have a transformation around the way you do things in compliance, around regulations, it's quite natural to expect some sort of a pushback from employees and other stakeholders. So it's very important that the people part of the equation gets addressed right up front. That's through communication and engagement, and giving all the employees the comfort that the transformation project that's being brought in is to help their operations and business, and it's not towards redundancies or to cost cutting or efficiency. So those are not the kind of words that I would start off if I'm focusing on a digital transformation, and that should never be the focus as well. So just to summarize, I would say getting everyone on board and having employees and internal stakeholders bought into that, and having a clear business focus are really the two key elements in my view.
Yes, absolutely. I would agree with that, Ajaz. Thank you. I think the cultural shift is just as important, actually, and understanding the need that we're trying to solve for. Absolutely agree with that. So, Caroline, I was going to ask you then, on that note, what are some of the most innovative, advanced approaches to compliance risk management that Standard Chartered Bank have implemented, and perhaps as a result of COVID-19? Be interested to hear if you have any examples that you can share with us.
Sure. Thanks, Emily. And actually, I just listening to Ajaz, I was reflecting back to the transformation journey that we've been on at Standard Chartered for the better part of 4 or 5 years now, which helped really change the mindset of all of us as employees over a long period of time prior to the pandemic taking place. And actually, the transition into sort of being more agile within the pandemic phase was much more smoother because we're already in a transformational type of season, if you like, for the past couple of years, and we expect that to continue to take place within Standard Chartered. I would echo some of the aspects mentioned by the keynote speaker today. We have been working on fairly similar tools as Colin's firm. We do, at the moment, have been really heavily utilizing external party vendors who are the gurus, so to speak, in this space, especially in AI. So when you cannot do it best, you better get somebody who actually knows what they're doing. And one of the big wins that we've had in and around this is on surveillance in our client due diligence process, whereby we use machine learning, and we've been doing that for the past 2 years, and we have managed to, it's about 99.9 accuracy. And in that particular process, we've managed to see a lot of efficiencies come through, reducing the amount of errors that are made, human errors. We're getting better analytics, getting to know our clients a little bit better than perhaps we would have in the past. Consistency as well, and the speed of execution in decision making has really improved. The other area that we've been working on is where we have compliance policies, and we want to really move away from having a human being interpret those policies at every instance. So we do have a tool, again, called Ask Compliance, relatively similar to HSBC, but in our tool, we have 2 interfaces. The first interface looks at the policy aspect of it. So I myself cannot recall the last time somebody asked me about a gifts and entertainment policy as an example, because actually this tool, which again is feeding off what people are putting in, you can ask it whatever question you want, and it can tell you exactly where in the policy you can find this information, which I think is very, very useful. So we've already launched that in the past 2 years, and we continue to add more policies on there. We also have another tool that is based on asking just any general question you may have in and around sanctions, ABC. And what we're trying to do there is, again, machine learning for general FAQs and better the type of responses that can be achieved. I would say COVID-19 hasn't really, for us, from a compliance regulatory perspective, brought in new aspects to what we were already doing. We were already doing this as part of our journey, transformational journey. So where we are now is really going back to that sort of 6-7 months period and saying, what have we learned, especially from our clients? What is client behavior really telling us from that particular season to enable us to build for the future? And also encouraging employees to actively seek new solutions for the future without just trying to solve for today. It is something that we're progressing on doing here at Standard Chartered within this compliance function as well.
Thank you very much. Thank you, Caroline. So, Will, I was going to ask you, you've touched on challenges and trends, but quite keen to understand if you think we've had any new compliance challenges as a result of COVID-19. And equally, have you seen any of those existing historical challenges go away as a result of the transformation journeys that we're all going through at the moment?
It's a tough question. I mean, to answer the second part first, it seems like challenges never go away. They just get added to, the sort of evolution goes in one direction. I think one of the difficulties in the technological transformations is sort of keeping your regulators abreast of what's going on and helping them understand that you're not losing anything in your risk control framework as you make changes. I think that's very difficult to do, and the technical aspects of the regulators are kind of changing and evolving just as they are in the financial institutions and big corporates. I think what's been so difficult about the COVID period is the compliance challenges have been multiplying even as you have the pandemic in the background. And, there are a bunch of big geopolitical concerns that were there from, Brexit and the UK standing up its own sort of regulatory framework and sanctions programs, to the presidential elections in the United States, and just a huge uptick in pressure over the last few months against Iran. Suddenly Cuba sanctions are coming out, keep Florida happy. And just there are a number of confounding trends all at the same time as banks are doing more with less in terms of human capital, time in the office, and in some cases resources. So, unfortunately, the situation is only getting more complicated. And so I think, to touch on things that Caroline and Ajaz have both referred to, it's smart evolution where these are businesses, it makes sense from a business perspective, but also where people are buying into these changes and making sure that these are helping people do their jobs better and more effectively, and not just adding another layer of systems or compliance onto what they're already responsible for.
Thank you, Will. And Ajaz, in terms of the audit work that your firm undertakes, how have you found that virtually? There's some obvious challenges there, but how have you guys managed to deal with that and succeed through it?
Indeed, it's a very interesting question. First of all, the way the audit industry is structured, a lot of our auditors have been used to working, at client sites, moving from one client site to the other. So from a culture point of view, a lot of our staff were used to working, on multiple sites, moving from one office to the other. Most of them were equipped with right IT infrastructure, be it laptop, being in terms of Skype, Team, etc. Those kind of technologies were all in place. The challenge we faced was, first of all, more from the client side, and that really depended on the nature of the client and the size of the client itself. If you're talking about a large client, most of them had the right technology, and the people were quite, understood how to use technology and how do you work remotely was inbuilt into it. Where we faced significant challenge was when it came to dealing with, say, medium and small size clients. Those were the ones which had, which faced the situation of do or die, really, right? They had to adapt to the change, or else there was no other way for them to get the results, the audited financial statements, etc., out in time. So that's where a lot of handholding had to happen. We had to train some of our clients around use of technology, create secure work environments, and that was really one of the major challenges that our clients were asking us. If we share this data with you on a remote platform, how secure is it? Because in the past, our clients were used to sharing that data, sitting in their boardroom, giving us, certain documents which were highly sensitive and private and confidential, and had to be looked at only by the relevant team members. When we had to make this whole shift, we had to, come up with some new solutions. Like, for example, we started creating, secure data rooms, what we call as war rooms for each of our clients. From an infrastructure, from a security point of view, make sure that even by accident, the client information does not get leaked out of the engagement team that's working on that particular engagement. So we ended up creating a lot of data rooms where only the relevant individuals from the clients and the audit team had access to it. And within that, the access was given only based on the need to know basis, rather than giving everyone the complete access.
Thank you. And just to leave some time for questions, I've seen ones just come in. To end the panel, and we could talk about this for much longer, it's very interesting, so thank you very much for your contributions. Just to end it, are there any key lessons learned that immediately come to mind when you think about what you've been through over the past several months that you would want to take forward? And are you believers in future-proofing systems and processes to really help lives become easier and be more efficient moving forward? Will, if you'd like to start, thank you.
You know, I think in terms of lessons learned, you know, staying flexible on IT infrastructure, but also somehow maintaining focus on cybersecurity. You know, I think Ajaz's point on data security is a really good one in terms of distributed personnel, because, you know, we're also seeing a huge uptick in cyber-enabled financial crime, where, you know, combining hacking and subversion of internal controls. So, you know, I unfortunately don't have any lessons learned. I think it's also difficult because we're still in the midst of the pandemic. You know, the announcement of the vaccine yesterday was very exciting. But even in a best case scenario, we're still 6 months away of life returning to normal. I think what's great is there is, you know, a change in what I think is reflexive stubbornness towards, you know, distributed personnel to transformations that, you know, regulators have been talking about for, you know, requesting for years. There was a joint regulator statement from the OCC, the Fed, the Treasury, and FinCEN a couple of years ago talking about exactly this issue. Didn't really, you know, cause any huge changes. But as, again, you know, referring back to Ajaz's remarks, you know, when it made business sense and regulatory sense, that's when you saw, you know, the huge changes. And I think it's tough if business is not leading, you know, the sort of shift towards better compliance, then it's hard to think too far into the future, because at the end of the day, it's just going to look like more costs. And if you can't accurately predict what the compliance environment is going to be like during that time period, then it's hard to justify you should make these huge upfront investments for new systems, new data, training, and personnel when you've got a bottom line to manage.
Yeah, it's very key. Thank you. Thank you, Will. Caroline, same question, please.
Sure. I agree. It's really difficult to predict. But I think the one thing that we have been trying to do is to be more future focused. So thinking of the risks that may crystallize in the future rather than waiting for them to happen now. Something that we've been doing in and around conduct risk, especially from a business lens, and preempting those scenarios and then building stronger, I would say, networks in and around our framework to make sure that we can withstand if something does happen in the future. I think the voice of the customer is extremely, extremely important. Listening to our customer needs and what they're actually saying from some of the things that we're launching, and just making sure that we're flexible and agile enough to quickly change when things don't really operate as they should. More to echo Will's point, there's a lot of information out there from regulators and learning from other regulators as well, because different jurisdictions are operating at different speeds. So for us in Standard Chartered, in the multiple markets that we are in, one of the key things is to make sure that that information is being shared as widely as possible, so that other centers may begin to adopt better practices, even where they might not be locally required to do so. And then lastly, I would say, especially in reference to the pandemic, when we do stress testing for our BCP plans, where we are looking at business resilience, we really do it to the nth degree rather than on the surface and saying, oh, okay, nothing's failed, tick, 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 and then off we go. And I think that sort of the BP oil spill case is a very good example, whereby if only they had really stress tested it to the nth degree of what such a spill would actually entail, perhaps things would have been different. And what we encountered in our organization, I would say maybe perhaps some of the IT infrastructure that we have is excellent, but it hadn't been tested to the degree that we've had to, where everybody now has to be at home using VPN. And I think those are some of the lessons learned in and around how we could do it better in the future.
Thank you, Caroline. And Ajaz, I might take this opportunity to ask the question. No pressure, but I thought it might be a good one for you to answer, and then if anybody else would like to contribute. The question is, how have you dealt with the differences in the way different countries dealt with the pandemic? Many countries gave flexibility to some regulatory reporting requirements, but they didn't all allow the same flexibility. and some are removing flexibility while others are not. So how do you manage this all?
It's a very tough question. You have to live through that, to be honest. The way we have handled this is, or we supported our clients handling this is, first of all, taking a view of each of the jurisdictions, understanding what the regulatory expectations are. As you said, rightly said, each of the regulators in the region, at least, they had their own bespoke approach on how they wanted to tackle their regulated entities, be it in terms of performing supervision, be it in terms of licensing, be it in terms of regulations, etc. So we took an approach where we really looked at each of the countries and the regulators within their geography, looked at how are they, what their expectations are, and then building from there. So for example, we had certain jurisdictions where the regulators had activated a lot of technology when it came to supervision, as opposed to sending people to the clients or to the FIs. They were, doing most of the reviews through on-site online supervision. So there the approach was creating, training our people and making them work more on an online basis with the regulators. But few other geographies, we had a slightly different challenge where there was a huge amount of requests that were coming in, from the regulators to supply with different types of data, be it around provisioning, be it around fin crime, anti-fraud. So really the answer to that is really, looking at, engaging with the regulator proactively, understanding where they're coming from, and making sure that, related entities work very closely with the regulator. That's the practical way we approached it.
Well, thank you very much. Thank you. I think that does draw us to an end. I really appreciate your insight. It's been very interesting. Thank you very much. Over to you, Elizabeth. Thanks.
Thank you.
Okay. Thank you very much for the panel. Obviously, we're just going to finish up now, but I think there was a few things that struck me from what you said. And I think, Will, you said about challenges don't go, they evolve. And I really liked that idea, is that you have to keep looking to the future. You can't get complacent in what you do. And what Caroline said about what they're learning is reinforcing it for the future. And I think those are sort of some very sensible things to take forward. Obviously, we're going to finish up for the day, and I'll introduce you to our Managing Director of Supervision, and he will give the closing remarks. Thank you very much.
Thank you, Liz. First, I'd like to thank everyone for joining us today for day one of our RegTech event. Special thanks to all the speakers and insights and all the discussions as well. Today's session gave us a good glimpse into what technology disruption and digital transformation looks like and what it means for risk management and also for financial services. Digital transformation is an ongoing process with many benefits, as we heard today. There are, however, challenges, so both in terms of adaptation, speed, at which the industry is also changing, and also trying to balance that speed and that adaptation as well, especially focusing on the risk as cyber risk, data security, AML, especially in the current environment. It was great to hear from Corin Lobo from HSBC on the fact that they are introducing more AI and robotics into screen payments, especially with the focus being less on the actual transactions and more on the actual customers themselves. Also very interesting to hear from the sanctions network intelligence that Karim is conducting at the moment, and the comments from Eric as well from Starling on his opening based on the Royal Commission into banking, which has shown the world in relation to how much operational risk can have an effect on the whole industry. In the last panel, we learned how COVID has had a direct impact into regards to business models as well. As a regulator, we're extremely challenged, just like the industry is on a daily basis. We are looking to, I guess, continue on with the industry and ensuring that we're able to expand and evolve with the industry itself, but we're also at front of mind, we don't want to jeopardize the safety of our customers or the integrity of the market as well from a financial stability perspective. I'll touch on this in further detail tomorrow, so then you can have a better understanding of our views in the use of technology, where we see the risks, and where we'll be able to address those risks as well. On that note, I look forward to all of you joining us again tomorrow. We'll be hearing from Smart Dubai on the digital transformation in the UAE. They'll be discussing the mitigating risks in regards to payments. You'll also hear from the DFSA on regulating and supervising in the area of digital transformation. And you'll also hear from the DIFC Authority on the future of finance in the DIFC. Thanks again for your time. I'll end it there, and we look forward to seeing you again tomorrow. Thank you, everyone.